Hi, welcome. My name is Amir. I am the founder at FinQuest Institute, and I am also one of the faculties for the Quantitative Risk and Finance program. In this video, we will do a detailed walkthrough of the QRFP course curriculum. The QRFP is a well-structured program whereby we have primers which are pre-recorded on Maths, Python, and Foundational Finance. The main idea behind having the primers is to help candidates build a good foundation before the live sessions begin. Now, what to expect as a part of these primers? So under the maths primer, we start with the basics. So understanding the definition of functions and their key properties, then building on top of it to understand limits, continuities, a very important concept called as Taylor series expansions. Many times we might have heard of this as a part of Maclaurin series. Then we focus on integral and differential calculus as well. We touch upon the ideas of both ordinary and partial differential equations. Then we have a module on probability theory and popular distributions. So here we try to understand the key types of distributions which are used in finance along with the basic definition of moments of the distribution. Also trying to link up concepts like the center limit theorem and understanding their relevance to finance and so on. We have a module on linear algebra as well, which focuses on understanding the definition of matrices. So things like matrix multiplication, inverse of a matrix, adjoint of a matrix. Also expanding further on the definition of vectors and their properties and how exactly these can be used for financial applications. Then we have the Python primer. Now, this would have the fundamental things which you require as a part of Python modeling. So starting with the basic building blocks, including data types, loops, conditional statements, etc. We introduce a few key common libraries as well. Of course, we are going to be using a lot of these libraries as a part of our modeling work in the live sessions, but then we'll have the basic introduction here. The Foundational Finance Primer has the required basic things on the ecosystems of a capital market, understanding primary and secondary markets, then building on top of it to understand the difference between the cash segment and the derivative segment of the market. Then basics on regulations, also fundamental ideas in time value of money, also expanding that to understand IRR and NPV concepts, basics of derivatives. We understand the most simple of the derivatives as a part of the primer, which is forward contracts. And also we have a basic introduction to interest rate swaps. Now, these things which we study as a part of the primer come very useful subsequently, because then the main idea as to why the primers are there is once the live sessions begin, we should not be spending time on basics, but the primers contain all the basic material which is required for candidates to either familiarize themselves or even revise some things which they might have studied in the past, so that they are all ready to start consuming the concepts as we start applying them in the live sessions. And also, as a part of each of these primers, we have a small exercise which is included as well. So the exercise on maths, Python, and foundation finance help candidates apply the things which they have studied as a part of the primer. So that way they understand and they're able to build a required amount of clarity on the required concepts as a part of this foundational material. Then starting with the main part or the core or the live sessions as we call it. So we start with module 1, which is fundamentals of risk management. So this includes the role of risk management in banks and lending institutions. Then the risk function, the roles and responsibilities as a part of the risk function, the common risk policies which are used as a part of the enterprise, risk reporting and risk management infrastructure, and also having a brief on the idea of risk appetite framework and risk appetite statement, which are very aligned with the business of the firm. Then we do bond mathematics. We do this because a good understanding of fixed income or bonds in general is very, very important to understand a lot of concepts which we study later on. So understanding bonds and their features, bond pricing, yield and spread analysis, price yield relationships. Also doing a bit of rates analytics, which is very, very fundamental, including things like spot rates, which we effectively can derive through bootstrapping the yield curve, forward rates, and the applications of both of these. We understand important risk sensitivity metrics, both duration, convexity, PV01, and their types. we touch upon the ideas of bonds with optionalities, which we often call as callable and puttable bond varieties and their properties. You will observe that as a part of this, there is a lot of mention of hands-on exercise. So whenever you see a hands-on exercise, these are primarily done in Python only. A few things we might want to do smaller calculations in Excel, but any kind of meaningful modeling, we do it in Python. We focus on Python because Python is a language of choice in the industry, and that is something which candidates find very useful because they can actually start using these Python skills as a part of their industry projects as well. So there's a list of hands-on exercises which are done under every module, which are enlisted here. And that way, the modules have been carefully structured so that they are building one step over the other, as you'll observe. Then after we're done with bonds, we get on with the ideas of futures contracts. Now, futures are very, very popular, especially when it comes to both trading as well as risk management as well. So futures is not a very difficult topic, or it won't be called exactly as math intensive as such, but then knowing futures is very, very useful because they are widely used by industry participants. So the properties of futures, cash and carry, reverse cash and carry arbitrage, the idea of margining in futures, then cross hedging using futures. Also, how you can do risk management through futures as well, which includes usage of interest rate futures in order to change the duration of a portfolio, or maybe using index futures in order to adjust the beta of a portfolio as well. So these things will be covered as a part of futures. After we're done with that, we touch upon the fundamentals of option contracts. So the design of options and their properties, what are the key factors or maybe the key inputs which go into any option, understanding the payoff equation and payoff diagrams for options. Very, very important, no arbitraging principle called the put call parity, and also trying to understand in case there is a mismatch in put call parity, how exactly one can trade in order to lock in an arbitrage. We do a review of key option trading strategies because then this is something which comes immensely useful, especially as a part of our module on volatilities, because when we do analysis of volatility smiles and when we do volatility models, be it something like implied smile model or be it like a local volatility model, etc. These option trading strategies, typically the straddles, strangles, butterflies, risk reversals come very, very useful. So we will be touching upon that as well. Then we get on with the discrete time system, which we also call as the binomial model. So understanding fundamental aspects of the tree and which help us learn two very, very important concepts called as risk neutral valuation and the delta hedging or a no arbitrage portfolio. Now, why we always study a discrete time system first is because the best part is a discrete time system can be shown by a diagram. So effectively, when you say a binomial model, you can show it by a diagram whereby you have just two steps of the world which you can go to, and that pictorially we can understand these concepts really well. And that way, these concepts come useful, especially later on as well. So that's why working on discrete time systems makes a lot of sense. We also understand how we can calibrate the tree to the market data, because then finally, if we use the binomial tree for option pricing, our number should be in line with what the market quotes. We also understand the impact of the increase in the number of steps and how exactly the convergence in option price happens. So here what I've shown is just a one-step tree, but then as a part of our hands-on, we'll use an n-step tree as well and see how the option price behaves. Then convergence is expected. We also understand how we can use a binomial tree in order to work on pricing of American options, i.e. options which have an early exercise. And binomial tree can be tweaked in order to handle American options very, very conveniently. So we will be having the conceptual discussion as well as the hands-on on both. Then module 4 acts as a very, very important bridge which helps us transition from the discrete time system which was done as a part of the binomial model before we can get on to Black-Scholes. So we call this as module 4, which is stochastic processes 1, 2, and 3. So here we focus on the ideas of randomness of financial assets, also focusing on the ideas of process diffusion, because then we'll be working on multiple assets. And in order to understand the dynamics of these assets, be it equity, FX, interest rates, volatility, credit, it is important that we are familiar with the ideas of process diffusion. So things like Kolmogorov equations are studied. we learn techniques how we can actually transform a higher order partial differential into something which you can solve by hand as well. So there are a few techniques which are out there, and we'll explore a couple of them in the live sessions. We also start building upon the ideas of geometric Brownian motion, because then GBM is a model of choice when it comes to the mathematical modeling aspects which we apply for asset classes. Then expanding on those concepts and then start learning Ito's lemma. So Ito's is effectively stochastic calculus. There are different formulations for Ito's which you study as well, which you can apply for different projects which you have at hand. So that way, depending on the asset class and the design of the product, you can apply the appropriate form of Ito's. So we'll be learning that as well. We'll see how correlated assets can be handled, because then many a times we may have certain assets or certain option whereby you have a dependency on two underlines, for example. Then in that case, it's important that we know how exactly correlated processes can be handled. So how that can be modeled and linking that up with the ideas of Ito's will be covered as well. Under stochastic process 3, we do a quick brush up of probability concepts which are required, especially from the idea of understanding martingales. So once we do the brush up of key probability concepts like conditional distributions and so on, we get on with the discussion on the basics of martingales. So martingales is another yet very, very powerful and a very elegant tool which helps us work on stochastic equations. So understanding the idea of Ito's integral and trying to show the equivalence between Ito's integral and showing that Ito's integral is a martingale. So that way there is a correspondence between an SDE representation for a random process vis-a-vis a martingale. So how that can work and how we can move from one form to another is something which we understand as well. Now, once we have stochastic processes knowledge with us, we are all ready to take on, I would say, arguably the most popular model in the industry, which we call as the Black-Scholes-Merton model. Now, focusing on BSM is a lot of advantage, and I personally like to call this as a Black-Scholes framework, because then it's very, very elegant and it's very flexible. So you can use that as a foundation, and then you can do a lot of other enhancements on top of it. But then but then as a part of this, we'll begin with the basics of the BSM model. We'll also derive the PD. Then from the PD, how do you come to the closed form formulas? That is something which we discuss as well. We discuss final conditions and boundary conditions for option prices and why they're important to solve the PD. We understand how model calibration of a Black-Scholes-Merton model can be done based on the current market data. And the market has done a lot of enhancements on top of the Black-Scholes model as well. So we understand those enhancements like having a more dynamic interest rate, volatility, or inclusion of dividends, etc., as a part of the BSM framework. Also, the basic or the core BSM model was worked on for equity options. We can expand that and apply it to FX and also for commodity options as well, which we discuss as a part of this module. Then we talk of option Greeks, very, very important sensitivity metrics for options. Like we know, every financial asset has a certain set of risk parameters. So option Greeks are the measure of risk parameters for options. So then understanding different definitions of Greeks, working those Greeks out numerically is something which we discuss as well. Also, how exactly dealers manage the Greeks of their portfolio will be studied. Then Module 7 focuses on ESOP valuation and warrants, especially useful for candidates who work in IPV profiles or maybe even in consulting roles which require a valuation of employee stock options. So what's the idea behind introducing an ESOP and the common definitions like vesting period, and what do you mean by exhaustion of ESOPs, or what do you mean by excesses of ESOPs, along with the required modeling in order to price the ESOP. So again, a variation of the binomial tree can be effectively used to factor in the things which you require in order to price an ESOP. So that will be discussed as well. We talk of warrants also because warrants happen to be another important instrument which is used by the industry. So we discuss the warrants valuation model also. Then we get on with numerical methods. Now, why numerical methods are required? Because in quant finance, there are only seldom cases whereby we have a ready closed form formula or a closed form solution. But then there are many, many problems for which we need to have some kind of an approximation. So that's where the idea of numerical methods or numerical techniques comes in. So We have already studied trees as a part of the binomial model. So that happens to be one of the numerical method. Here we understand the Monte Carlo simulations and a couple of variations on top of it. We also talk of finite differencing scheme as well. And we do a lot of hands-on work also for this. Then generally after we complete our discussion on the stochastic calculus, numerical methods and so on, we do a revision class on applied maths concepts which we have discussed so far. Now the main idea behind doing this revision class is so let's say in the first 9 weekends, let's say 8 to 9 weekends, we have done a lot of mathematical finance together. So then these revision classes come very useful for candidates in order to brush up and revise concepts. So we do 2 extra classes on weekdays, which are live sessions of 2 hours each, whereby we do a full revision of the applied maths concepts which we have studied right from module 1 up till date. So that way, this is something which will come useful not just for the remaining part of the course, but then it will be useful later on industry projects for candidates as well. Then we revisit Black-Scholes-Merton through the martingale's approach. So that way, we already discussed the ideas of PDEs and how you can solve a partial differential equation as a part of the earlier modules. But here we touch upon the ideas of martingale. So martingale, as I mentioned, is another very, very elaborate and elegant approach to work on different problems which we come across in quant finance. So then we can use the martingale's idea like equivalent martingale measures, the Kirsanov's theorem, the Radon-Nikodym derivative, and other specifics pertaining to martingales. And we can use it to solve the BSM as well. So another yet very, very powerful tool. So we'll be studying martingale's approach applied to options pricing. Then we have a module on model portfolio theory, typically talking of the ideas of efficient frontiers, the ideas of capital allocation line, capital market line, how exactly you factor in investor risk aversion as a part of the calculations. Then working on different portfolio optimization techniques. So applying things like the necessary condition and the sufficient condition, which we also call as the gradient and the ACR operators. We learn both the things. So we'll try to do portfolio optimization without constraints. We'll also try to apply constraints and try to solve that as well. And subsequently, we touch upon how we can do active portfolio allocations through another popular model which we use in the industry. Now, this module comes very, very useful, especially for candidates who work in asset management, because then portfolio optimizations are something which they do a lot as a part of their day-to-day line of work as well. Then we have our module on market risk management, which includes value at risk and conditional value at risk, which you also call it expected shortfall as well. So then understanding the definition of VAR, different types of value at risk models which are out there, then understanding the concept of a stressed VAR model, why it's important. Then any model which we build, we should be able to understand whether it's fit for purpose. So then understanding the idea of backtesting a VAR model, how do you do that in practice and why it's done as well. Then expanding on the concept of VAR and try to understand what do we do about tail losses. So that is something which we study as a part of CVAR, or many times also called as an expected shortfall, or ES as well. So what is ES? Why is it a coherent risk measure? And why it's important is something which we discuss. Because then that way, for our friends who may be familiar with the FRTP guideline, expected shortfall is getting increasingly consumed as a part of risk measurement as a part of FRTP. Then we have our module on volatilities. So since we have already studied the ideas of option trading strategies in the past, we are in a good position to begin the analysis of vol smiles. So then understanding the volatility smile, how you can actually work or analyze a vol smile for equity and FX options is something which we cover. We understand how a vol smile can be constructed as well. So those concepts will be covered here. Then we have a detailed module on volatility models. So we'll have things like, of course, the implied vol model, which we study as a part of smile analysis. We also do local volatility models, which is like one step above our earlier discussion on vols. We also touch upon parametric vols as well. So things like GARCH, EWMA, those kind of models, which are again popular in the industry, will also be studied. We also do fundamentals of stochastic volatility modeling, whereby we try to take our attention towards the Heston's model for for stochastic volatility, along with the hands-on for the same as well. Then we have a scheduled 1 weekend mid-course break, which we always do. So this is like a good time for candidates to revise concepts, to catch up on any kind of practice exercises which are remaining either from the maths problem sheets or the Python hands-on exercises which have been uploaded in the past. And also they get time to unwind and relax as well. Then after we come back from our 1 weekend break, we do an overview of regulations. So that way regulations by themselves can warrant for a separate course altogether. So here the idea is you want to understand what these regulations are, because then in many of the quant or risk management interviews which are done for the contemporary roles, it's expected that a candidate should be familiar with regulations. So then focusing on newer regulations like FRTB, studying the ideas of standardized approach, internal models approach, also reviewing the Basel III approach, which has been around for a long time, and understanding the calculations for CVA capital charge, the market risk capital charge, off-balance sheet charge will be covered as well. And then connecting things from a risk supervision perspective, including on-site supervision and the risk-based supervision, which is done by banking regulators. Then we have a module on model risk management as well. Very, very important, because then model risk happens to be one important source of risk which every bank or lending institution wants to keep in check. So then understanding the best practices in model risk management, and earlier we used to focus on SR 11.7. So of course we will be covering these guidelines, which because they have been around for a very long time and are considered as a global best practice when it comes to MRM or model risk management. In addition, we'll also study the enhancements which have been done to this, which we now call as SR 26.2 guideline. This will be covered also. Then we have a module on interest rate derivatives and interest rate modeling. So understanding the design and valuation of popular products like interest rate swaps, swaptions, and also interest rate caps, interest rate floors, collars. Then expanding on this in order to understand the short rate models, typically starting with the Vasicek model, understanding the bond pricing PD, and then expanding it further to understand the Cox-Ingersoll-Ross, the Hull and White trigonometries, and also calibration of these models to the market. Then we have the module on credit risk management, focusing on the core modeling aspects of PD, LGD, EAD, stress testing, model validation in practice, also understanding decision-making models versus regulatory capital models, the credit rating scale, master's rating scale, and a lot of relevant concepts which we use in core credit risk. Then we have a module on economic capital as well. So understanding the difference between economic and regulatory capital, and then leading to further definitions of expected, unexpected losses. What do you mean by unexpected loss contribution? How do you do the modeling for unexpected losses? And how exactly economic capital can be kept commensurate to the kind of target rating which a certain bank is gunning for. Then we have credit derivatives, which are very, very popular when it comes to counterparty credit risk management. So then understanding things like the Mertens model and its variations, including KMV. We also do intensity or hazard rate models, then learning credit default swaps, also understanding the big reforms which have happened as a part of CDS, which we call as Big Bang reforms, which are now the convention of CDS. Then how you can extract probability of default from traded market instruments like risky bonds or from CDSs, and also looking at other credit derivatives also. Then we touch upon other aspects related to counterparty risk, including trade exposures, limits, how do limits get monitored on a real-time basis, and so on. We touch upon central counterparties because CCPs are something which play a very important role in ensuring that the overall systemic risk remains in check. So then how exactly do they guarantee clearing and settlement through the ideas of margining and also the ideas of loss mutualization, trade auctioning. That is something which is covered as a part of CCPs. Then we have a module on what we call typically as the XVAs. Of course, we'll not be doing the entire XVA framework, but we'll focus our energies towards CVA, DVA, and wrong way risk. So what these concepts are and the modeling behind that will be studied as well. And then we have a module on machine learning, deep learning, and AI models applied to finance. So that way, as we know, AI and machine learning has already made its inroads into almost every industry, and quant finance is also no stranger to it. And we see a lot of applications of these tools. So then understanding the different types of ML models like maybe supervisory, unsupervisory, reinforcement learning, etc. would be there. Then typical common models like maybe a PCA model for dimensionality reduction, also things like the clustering models, typically k-means or hierarchical clustering, which are used. Also popular ideas like feature engineering or feature elimination. Also, what do you mean by gradient descent, and how exactly do you fine tune the learning rate in order to optimize to a certain solution? Then we also build on top of these concepts to understand things like decision trees, like maybe random forests, and applying logistic regression for different kinds of maybe classification or estimation tasks. We learn artificial neural networks or deep learning models, and typically our focus is on LSTM, which is long and short-term memory, which is another very, very common model which is used by the industry for, let's say, asset price estimation. We'll be talking of a few AI models and also focusing on the governance principles which are used globally as well. We discuss the fundamentals of natural language processing, typically focusing on news sentiments, because then that is something which gets used as a part of a lot of trading decisions also. We have an introduction to Gen AI and also the fundamental applications of agentic AI or those kind of autonomous models which we use in finance as well. We do a host of hands-on activities on a lot of these concepts. And also when it comes to assessments, there will be periodical assessments, I would say almost weekly assignments. Either it can be on applied maths or it can be on hands-on Python. And there is end of the course project as well, which allows candidates to combine all the things which they have studied during the course. Also, over and above the course modules, we have add-on modules which we create as well. So add-on modules are those concepts which you don't cover as a part of the curriculum, but something which candidates will still find useful. So things like maybe time series analysis or risk governance or even operational risk management, parallel computing, and so on. So, and that way the add-on modules is a very flexible folder. So we keep on adding the newer topics which are relevant to the contemporary markets as a part of this. So this completes our walkthrough of the course file. So about the July 2026 QRFP cohort, the live sessions will begin from 18th of July 2026. The live sessions happen on weekends and they get recorded so that way candidates can go back and revise concepts. The course duration is 5.5 months on weekends, and we plan to complete this cohort 1 weekend prior to Christmas. This is the 6th batch of the program. The primers which I had mentioned earlier, which are on Maths, Python, and Foundation Finance, are already uploaded on the students portal and they become instantly accessible upon sign up. Then other things, as we mentioned, regular assessments during the duration of the program and also end of the course project. So both of these help candidates build full clarity and confidence on the concepts which we study along the way. We support the career aspirations of candidates. So then we leverage our industry and client network in order to help candidates, in order to push the candidate CVs to the right places so that they can start appearing for any potential job roles which will be opening up in the quant analytics space. And then we have, so when I say doubt solving sessions, we have live sessions. So that way candidates are free to ask any kind of queries and questions during the session. We also urge candidates to go back and revise concepts and subsequently come back with any queries which they have, which helps in building full conceptual clarity as well. So do visit the website or get in touch with the coordinates below. If you love the course, you can sign it up directly from the website, or you can scan the QR code here, which will take you to the course page and you can join in the program. So looking forward to having you as our candidate for the July 2026 cohort of the QRFP program. Thank you.